Toyota battery manufacturing in North Carolina just opened near Liberty, in northeastern Randolph County. This huge project is worth nearly $14 billion and is expected to create over 5,000 jobs. As production ramps up, the massive $14 billion facility at the Greensboro-Randolph site is just weeks away from shipping its first batteries. What surprised many was Toyota's quiet shift northward, not with a loud announcement, but through clear actions. Washington expected Toyota, a global auto giant, to keep its strong U.S. base. Instead, Toyota started leaning heavily into Canada. This change wasn't a small tweak. It felt like a major shift in North America's electric vehicle, EV, future. The main trigger, a serious threat of nearly $800 billion in U.S. tariffs on Japanese exports. Facing this financial pressure, Toyota had to rethink fast. The company warned of a 21% profit drop in 2025, showing how the tariffs hit hard. Toyota revealed that tariffs from the Trump administration alone would cut their earnings by $1.25 billion. They also faced losses of 745 billion yen. In the fiscal year ending March, Toyota produced 3.22 million vehicles in Japan and shipped around 542,000 to the U.S., showing how big their U.S. market role is. But public reaction in the U.S. was quick and critical. Several states accused Toyota of turning its back on American workers by deepening ties with Ontario and Quebec in Canada. Toyota Canada responded calmly but clearly. They are committed for the long haul. This isn't just a short-term move or a minor strategy change. It signals a broader plan to operate beyond U.S. policy uncertainties. So, is Toyota just dodging tariffs, or is this a bigger shift in the North American EV industry toward Canada? The story goes beyond tariffs and profit losses. The whole supply chain is under pressure. U.S. policies made operating in the U.S. costly and unpredictable. Steel tariffs, component tariffs, a weak dollar, and changing EV incentives turned long-term planning into a gamble. What once seemed certain became shaky. Toyota's U.S. EV production in Kentucky, key to their strategy, faced delays pushing full operation to mid-2026, disrupting years of planning. Their popular Tacoma truck might move to Texas to avoid tariffs on Mexican-made parts. The supply chain became unstable, with costs jumping after every new tariff. EV production depends on steady inputs and clear rules, which became a monthly challenge. Plus, the U.S. can't supply enough parts that meet the Inflation Reduction Act, IRA standards, forcing Toyota to look overseas for reliable, compliant materials. How can a company spend billions on EVs when the rules keep changing? Toyota found the answer in Canada. While the U.S. has mining capacity, it lacks large-scale refining. Canada not only has the minerals, but also strong processing power. First Cobalt Corp is building the continent's only cobalt refinery, securing a key battery material source. Quebec and Ontario are setting up battery and component factories right next to Michigan and Ohio's auto hubs, making logistics smooth. These Canadian facilities meet IRA standards, helping Toyota keep vital tax credits while U.S. makers struggle with the same rules. Plus, incentives linked to the U.S. Defense Production Act support Canadian refining, indirectly benefiting Toyota. Canada provides raw materials and processing the U.S. can't match. Quietly, Toyota increased its investment in Ontario and Quebec, creating an EV corridor protected from U.S. tariff and rule changes. This zone lies right beside Michigan and Ohio, letting Toyota move materials and assemble with little border hassle. Canada's advantage is growing fast. Ontario is $15 billion Honda EV program, and Quebec, as $2 billion GM investment, build a strong ecosystem, attracting more investments and speeding progress. Toyota's long-term commitment shows Canada isn't a temporary fix. It was a key base for EV manufacturing. In an industry where projects last decades, policy stability is crucial. Canada offers consistency the U.S. struggles with. Ontario and Quebec act as a safe zone where Toyota can push its EV plans without worrying about sudden political changes. But this shift caused tensions in the U.S. What looked like a logistics tweak became a strategic worry. States with big auto sectors expressed concern, accusing Toyota of moving jobs and money north. Federal lawmakers worried Canada might be a backdoor, letting foreign automakers get U.S. tax breaks while U.S. plants bear the risks. Delays in Toyota's U.S. EV projects made these concerns worse, with questions about whether EV infrastructure investments will pay off. Here's the paradox. The US wants to lead in EVs, but policies meant to help domestic production have pushed foreign automakers to seek stable options elsewhere. Toyota's move highlights a bigger trend. The EV industry is shifting toward places with mineral supply, refining ability, and stable policies. Canada offers all three, giving a certainty the US can't yet match. This change isn't about leaving the US market. It's about finding a steady place for EV production that avoids risky tariffs and policy swings. Every Canadian investment makes the region more attractive. Mining projects in Ontario and Quebec are growing fast, while battery factories make sure materials flow smoothly to plants just across the border. These clusters cut risks and costs and ensure production meets both local and international standards. For Toyota, going north is a smart move to protect billions in EV investments with a stable base. Other automakers face the same challenges. From IRA rules to tariffs and supply chain problems, Canada's integrated approach makes it the hub for the future of EVs in North America. This mix of resources, refining, and steady policies is hard to find anywhere else. Companies wanting long-term stability are flocking to the Ontario-Quebec corridor. Success in EV manufacturing depends on more than assembly lines. It needs secure supply chains and efficient processing. Toyota's shift shows how companies think beyond just costs, weighing political risk and stability. Canada naturally fits the bill. Its minerals, refining, and clear policies give Toyota the confidence to invest big. This move isn't temporary. It's a smart, long-term plan. Canada is shaping up as the foundation for North America's next-gen EV industry. The corridor between Ontario and Quebec combines easy logistics, key materials, processing, and strong incentives that keep growing the cluster effect. More facilities and programs mean automakers can scale up faster, without the uncertainty they face in the US. Toyota's approach is a careful, forward-looking strategy. Using Canada's stability, the company shields itself from sudden policy changes and secures critical parts for EVs. This move is part of a wider trend. The future of car-making favors regions where resources, refining, and clear rules come together. Right now, Canada offers the most complete package in North America. For the US, this raises tough questions. Can policies be fixed to keep manufacturing here? Will US supply chains evolve fast enough to meet EV demands and offer the stability automakers need? Until then, companies will keep investing where they find predictability and full support, and that's increasingly Canada. The EV industry's future is about how policy, resources, and business strategy come together. Automakers now think about political risks and stable operations as much as costs and tech. Canada's combo of minerals, refining, and clear rules gives it a big edge. Toyota AS shift north isn't leaving the US, it's adapting to tough conditions with smart positioning that lowers risk and locks in resources. Toyota ES move is a clear sign. North America AS EV future is leaning where stability and resources meet, and that place is Canada. Thanks for watching. Drop your thoughts in the comments below. If you liked this, check out the video on your screen now and don't forget to subscribe for more updates.